Hello and welcome. I'm Ruchira and I'm joined by Rajeev Thakkar. He's CIO of PPFAS Mutual Fund. And if you've ever wondered why buying the dip isn't a magic bullet or how to stay sane when markets zigzag, you're in the right place. For today's conversation is all about stepping back from the noise and understanding how market cycles really work and if a dynamic approach to investing can help you navigate uncertainty. So welcome, Rajeev.
Thank you so much for the option.
Great to have you here. To begin with, you talk about markets as cycles and not as straight lines. So, in today's world where everyone's chasing momentum or pouncing on every oversold chart, how do you help investors realize that the next cycle might look completely different from the last one?
So, Ruchira, one interesting statistic comes out all the time in terms of how many demat accounts have been opened in the last 5 years, or how many new investors have come to mutual funds in the last 5 years. So, a lot of the new investors think that allocating money to equity is a magic bullet, and just because you allocate more money to equity, you deserve 2x or 3x the returns that the bank FD or the bonds give you. So if the bonds are giving you 5 to 6%, people come with the expectation that, oh, just because I've allocated to equity, I should get somewhere around 15%. Now, this does not work that way. Equity allocation typically pays off in the very, very long run. And when we talk about the long run, people think, oh, under the Income Tax Act, if you hold a stock or a equity mutual fund for 1 year, that gets classified as long term. So I can hold for 1 year and I can withstand the ups and downs.
Right.
Whereas 1 year is not really long term when it comes to asset allocation. Today, when we are speaking, we are mid to end July 2025. And if we look at 1 year performance of, let's say, the Nifty 50, it's been somewhat flattish. So people could say that Nifty has not done as much as even a bank fixed deposit. Now, people may think this is an aberration, but we have had a period, let's say, from March or April of 1992 to March of 2003. Over 11 years, the Indian stock market went nowhere and, in fact, was in negative territory.
Right.
Again, we have seen a lost decade in the US markets, 2000 to 2010, or Japan has had a very long period of very minimal equity returns. China has gone through this phase. So, one thing I want to highlight is just because you have a 1 year or a 2 year horizon doesn't mean equity will give you fabulous returns or returns that very, very easily beat the bond returns. So at one end, one has to keep in mind that while equity has the potential of giving much higher returns, this plays out over very, very long periods of time, sometimes as long as more than a decade. So that is to be kept in mind. Now, equity is good for wealth creation, but it is good for a 20, 30-year-old having maybe 30 plus years to retirement, and where someone regularly puts money in equity as an asset class. But for people with moderate or lower kind of tenures to their financial goals, it makes a lot of sense to have a mix of fixed income and equity. And also keep in mind the valuations that prevail in the two asset classes. So if valuations are not very conducive, it may make sense to have a lower allocation to asset classes like it.
So, in this context, let's talk about your Dynamic Asset Allocation Fund. Can you please share with us what is its positioning in your overall fund lineup and what kind of investors is it best suited for?
Sure, Ruchira. People who are looking for longer term growth can opt for our equity schemes, things like FlexiCap or the ALSS tax saver. When I look at the target customer for our Dynamic Asset Allocation Fund, in my mind, I typically see a retiree who's maybe 55, 60 years of age and who has a long period in retirement ahead of herself or himself, and who has multiple objectives, which may sometimes be at conflict with one another. At one end, they don't have a fixed tenure in mind, because if someone retires at 60, that person could have 20 years ahead, 30 years ahead, or even 40 years ahead, given the longevity. So there's no fixed tenure in mind. Secondly, there's a preference for liquidity. So sometimes unforeseen expenses may come up, medical needs or some other needs, and there's a need for liquidity. There's also a need for regular cash flows. People may want monthly payouts or withdrawals to meet their uh, expenses. And at the same time, there is fear of inflation eroding their purchasing power over the medium to long term. And while all these needs are relevant, they also want a tax efficient structure under the uh, prevailing tax laws. So this is the target customer in our mind for our dynamic asset allocation fund.
All right.
We would want to give them predictable or somewhat regular cash flows with a dash of equity to protect the purchasing power to some extent.
All right. So, given that a major portion of your fund is in debt and hedged equity, how do you determine when to increase or decrease your allocation to debt?
So the yields in debt move up and down all the time. This is based on the market's expectation of RBI moves, and sometimes in reaction to the interest rate decisions in the short end or the uh, medium term, based on the liquidity inflows and outflows in the banking system. So let's say if RBI cuts rates 3 times in a row, or RBI is cutting repo rates aggressively, bond yields tend to come down, and vice versa. When RBI is increasing rates, bond yields tend to go up. Now, another segment which can give somewhat predictable low risk returns is the arbitrage segment, which is the hedged equity that you referred to. Now, this depends on market sentiment, how aggressive speculators are in terms of bidding up the futures prices as compared to the cash market levels. We keep evaluating the arbitrage spreads and the bond yields at all points in time, and we have a mix of hedged equity and the bond allocation. And depending on the attractiveness, we can take up one segment versus the other and keep rebalancing.
Can you explain the fund house strategy? Because when everyone else seems to be favoring equity funds, why are you increasing exposure to the debt category? What is the reasoning behind that?
Sure. So a lot of people look at balanced advantage funds or DAF category funds as something where you can make market calls in terms of next 1-2 years. Do you see equity doing well, or do you see bonds doing well? And they position their funds accordingly. Our objective is to, one, be predictable for the end investor in terms of what category the taxation will apply. So now there are three tax categories for end investors. One is where equity is 0 to 35. Second category of scheme is 35 to 65. And the fourth category and the third category is where equity allocation is more than 65%. So our objective is to keep the equity allocation between 35 and 65, so that investors have that predictability in terms of what tax rate will apply and what is the holding period that they need to hold the fund for. So the 35 to 65 category, investors have to hold for a minimum period of 2 years. Within that, we keep deciding between hedged equity and debt. So since I said that the target customer is a retiree or someone who's very conservative, we don't intend to take unhedged equity to a very, very high level. So currently, unhedged equity would be in the region of 15% or 20% kind of range. And these are again largely cash flow yielding securities, either in terms of dividends or sometimes special payouts like buybacks, etc. So we are not targeting really a growth oriented investor, but we are targeting a cash flow oriented investor with this scheme, and hence the lower equity allocation.
Okay. But as critics say, the dynamic asset allocation, it underperforms when bulls run wild. So you're saying that you're deliberately accepting that trade-off to manage risk.
That is correct. So one, in a bull market, it will definitely underperform the aggressive equity allocation funds. That's a given. But it's very difficult to predict whether we are going into a bull market or whether we are going into a prolonged sideways or a downward market. Last year, as we have seen, it's been a very, very sideways kind of market. So given our target market, given our end investor profile, we would want to be on the conservative side of unhedged equity.
Okay, and you've said that your fund focuses on conservative investors, but for investors who are used to jumping on hot trends or reacting to every headline, how can a dynamic asset allocation framework build smarter, more disciplined habits over the long run?
So first, our dynamic asset allocation fund may not be suited for such an investor. But there are people who, or there are fund houses who change the allocation very meaningfully between equity and debt category, and who try to be aggressive. Again, there are two variants in this. One variant is where people tend to be pro-cyclical, that is, they increase equity allocation when markets are rising, and they work on some sort of a stop loss kind of mechanism where if the markets start falling, they aggressively cut the equity allocation. So this is one kind of flavor of DAFs. The other flavor of DAF is where they keep in mind the valuation, and when markets are down and out, that is the time they increase equity allocation, and they reduce when valuations are high. So depending on one's risk profile and preference, one could choose those schemes that protects against very, very prolonged sideways or a bear market kind of situation.
All right. Well, with that, it's time for us to wrap up this conversation. Thank you for sharing your insights on the PPFAS Dynamic Asset Allocation Fund and the strategy as well. Thank you.
Thank you for the option.